Hi everybody, it's AJ speaking. There was major news on Nvidia. Today is July 15th. It's a little after 9 o'clock in the morning when I post this to subscribers. Nvidia is up over 3% in after hours trading on this new piece of information. Market cap closed last night at just over 4 trillion. So there's another 3.5% on that number right now. So what happened? So this is what happened. Nvidia announced that Nvidia can resume sales of H20 chips in China. This is big news and has various ramifications for Nvidia. And in this video, I want to dive in what this means for investors and answer the key question: is it time to take profit on this spike this morning, or is this premature? So side note, this was published at 3:51 a.m. in my time zone. It's right now 9:16 a.m. So this is 5 hours old. This happened in after hours trading. And right now, Wall Street is probably still asleep and hasn't fully digested this news yet. I expect Nvidia to trade up further on investors fully digesting what this means. After a few weeks, I will make this video widely available to retain value to my subscribers. So here on this first slide, you see the updated revenue outlook. The way this is modeled right now is that from Q3, which in Nvidia's case ends at the end of October, we will see the first impact of this news. Since this news just broke today, July 15th, and Nvidia's quarter closes at the end of July, there would only be roughly 2 weeks for Nvidia to ship product to customers. Although it's feasible or theoretically possible that Nvidia can still ship some H20 product, for conservatism, I'm reflecting impact only from Q3, so the quarter ending in October, and then a full impact in the subsequent quarter ending in January 2026. What this actually entails, let's have a quick look into the model. So the relevant line is here, so line 165. This is how can I explain it? An add back of a time-shifted revenue stream that was inferable from prior Nvidia management guidance before the H20 ban was announced earlier this year. So let me translate this into more normal English. So before the H20 ban, and then as part of the H20 ban, there were various announcements from Nvidia, the right of announcement, etc. And there was data from which you could, also in addition to some rumors, you could infer what was the approximate H20 revenue Nvidia estimated before the H20 ban. So I've used those numbers and pushed them 2 quarters. So basically, this 2.5 billion was the remaining unrecognized H20 revenue that Nvidia disclosed for the first quarter. So in the first quarter it was the H20 ban, and Nvidia managed to ship still 4.6 billion, and they couldn't recognize 2.5 billion. I'm pushing this conservatively into Q3, and then from other disclosure you could derive that approximately 8 billion in the subsequent quarter from Q1's perspective. So in Q2 was originally envisaged to be shipped to China. So now I'm shifting this to 2 quarters, how you end up in this number. And then these 2 numbers were some derivatives from other disclosure. And from this point, this is just a simple extrapolation, assuming a conservative 10% growth rate, because right now we don't have any basis on which to base this Nvidia market potential in China. Because again, remember, Nvidia is not allowed to ship their latest gen products in China, and there's Chinese competition is growing, and it's very likely, and this is also based on what Jensen Huang said, that homegrown Chinese products will soon exceed the significantly handicapped products that Nvidia is allowed to sell in China. If Nvidia was allowed to sell Blackwells anytime soon, then this would increase massively. But right now, the forecast is not expecting such a scenario, but this would be a huge upside. But at present, I deem it unrealistic that the current administration would allow such a move. So this was the prior slide. So this is basically driving the earnings uplift, and this also explains the bump or the first jump in Q3 as the H20 sales kick in, and then the bump that I just explained in the subsequent quarter, so Q4. So this is why we move from 55 to 66 billion in a single quarter. So I will be going through the next model slides relatively quickly, so we have more time to spend on the valuation slides to keep this video as short as possible. This slide just shows you the revenue breakdown. You can see amongst Nvidia's main segments, even though other segments also based on Nvidia guidance see some material growth, the data center segment overshadows everything else. This is just a quick look on cost of revenue. This slide is not very meaningful because you need to look at it in terms of margins. The key thing to point out here is, number one, there are always significant cycles with Nvidia's very consistent product refresh cycles. So the most recent one was Hopper. Currently we're in the Blackwell era, and already next year we enter the Rubin era. This slide is much more important, shows you the gross margin. You see the massive drop in April. This was caused by the H20 ban. Nvidia had to take a huge write-off and other accounting adjustments because of it. The forecast, also this is based on Nvidia guidance for 2025, reflects a consistent recovery. What this forecast conservatively does not reflect is a potential gross margin boost from the now resumption of H20 sales. The wavy nature of this gross margin development reflects Nvidia's product cycles, which are characterized by lower gross margin early in the ramp, as typically yields of these new high-end products tend to be low, and that's why Nvidia has to throw away a lot of material in the beginning because they have some defects. This is the same analysis, but shows you a long-term view. This slide shows you the long-term gross margin trend, and you can see the cyclical nature plus some outlier events. So, for example, in the second quarter of 2022, Nvidia had some supply issues, was a huge buying opportunity. Then also the H20 ban-related write-offs caused a drop to 61%, was another huge buying opportunity. And you see the trend implied by the forecast also reflects this wavy gross margin pattern aligned with the announced product cycles of Nvidia. This slide shows you the gross profit impact. You see Nvidia grows to truly amazing scale, and the growth rates are still eye-watering, although they come down significantly. But of course, this is expected at Nvidia's enormous size. So my forecast implies 150 billion in gross profit this year, 215 billion next year, goes to 280 the year after, and the final year of this explicit forecast in the year, the financial year ending in January 2029, 245 billion gross profit. So this forecast also reflects enormous increase in operating expenses, and this is primarily driven by research and development expenses. The forecast reflects a 44% increase year on year in this financial year. Next financial year, 40%, 33% increase, and then 27% increase in the fourth financial year in this forecast. Truly enormous scale. So, for example, last financial year, Nvidia spent 13 billion on R&D. This year, I expect Nvidia to spend 19 billion, goes to 26 billion, 35 billion, 44 billion. This will make Nvidia one of the largest spenders on R&D globally. This increase in R&D spend is driven by Nvidia fortifying its technological leadership, and a significant part of that is the ongoing war for talent. Nvidia will not be immune to hiking compensation packages for key engineering talent, but I think this is reflected in this R&D expense forecast. This slide also reflects the conservatism of this forecast. You can see the R&D efficiency, which is R&D expenses divided by total revenue. So in the first quarter of this year, Nvidia spent 9.1% of total revenue on R&D expenses. I expect, for various reasons, this to go up slightly in the current quarter to 9.3%, and then come down, and in part driven by the now H20 sales resumption. And then I expect actually a slight deterioration in R&D efficiency despite Nvidia's enormous revenue growth, which shows you the conservatism in this forecast. So this slide just shows you SG&A expenses, so they go up, which should be expected, of course, because Nvidia gains enormous scale. But more interesting is this slide. It's the SG&A efficiency. So similar to R&D expenses here, this analysis looks at what SG&A spend amounts to relative to total revenue. And you can see this came down meaningfully over the last couple of quarters in Nvidia's case. I expect flattish SG&A spend in the second quarter, and then some relatively modest improvement. Again, this is relatively conservative. Key drivers will be Nvidia's, first of all, increase in scale, so revenue growth, but number two, also Nvidia's widespread in-house use of AI, basically making everyone more efficient. So this chart then shows you the combined, so R&D expenses plus SG&A expenses, so in total called operating expenses. You can see there's a material growth forecast or a part of this forecast. For example, this year I expect 41% growth, next year 38% growth, the following year 31% growth, and then finally of this forecast 26% year-on-year growth to a massive OpEx base of 53 billion. And for this year, I expect a total OpEx base of 23 billion. Then here again, the same type of analysis we looked at earlier. So what does total OpEx mean relative to total revenue development? And here again, this reflects a conservative forecast. OpEx is forecast to stay basically right around 11%, which is quite conservative given that Nvidia's revenue will grow to a truly enormous scale. So because we have a, let's call it fairly linear development in operating expenses, but this wavy development in gross profit based on driven by Nvidia's product cycles, we have a similar pattern in Nvidia's operating margin development, which you see on this slide. I forecasted Nvidia's full year operating margin will be just under 60%, and this was primarily driven by the first quarter with the massive write-off on the H20. But throughout the forecast, I expect operating margin on a full year basis to consistently come in slightly above 60%. This will then translate into enormous operating profit generation. This is what you see on this slide. So in last financial year, Nvidia generated 81 billion operating profit. I expect a 56% year-on-year growth. So this year to 127 billion operating profit grows in the subsequent fiscal year ending in January 2027 to enormous 183 billion operating profit. Continues on to exceed 200 billion in the fiscal year ending in January 2028 and in January 2029, and Nvidia is approaching nearly 300 billion in operating profit. At this point, you might be sitting in front of your computer or looking at your phone and thinking, oh, AJ must be crazy. This is not pulled out of thin air. I covered this previously, but very briefly. The primary driver of all of this is number one, the global data center infrastructure, which is worth a lot of money, put it this way, will be transitioned towards accelerated compute data centers. So you go from almost entirely CPU-based, retrieval-based data center to almost entirely based GPU-based accelerated compute data centers, which will not be retrieval. 99% of the time, it will be mostly generative. That's the key thing. And on top of this transition of existing infrastructure, there's the typical growth of global DC infrastructure, plus the incremental growth that is unlocked by the AI race. So in other words, you have basically three underlying growth drivers that compound. And this creates a truly enormous market, and my forecast reflects material market share loss of Nvidia. So this is to capture all the alternative providers from China and other countries emerging, scaling up, other companies like AMD and a few others. It also captures the hyperscalers' in-house products and other efforts. So if you see news, hyperscalers so-and-so launches new AI chip, etc., this is all accounted for in this forecast. I think what most people can't properly understand yet is the truly enormous size of this market. And I think the way you should think about Nvidia is not selling GPUs. Nvidia is literally selling intelligence. And there will be an insatiable demand for intelligence. The AI race is increasingly compressed down into a compute race. But I'm not going to dive deep into this topic in this video, because this would make this video way too long. We're almost at the end of the P&L. This slide just looks at the non-operating items. Not a major needle mover in Nvidia's case, but as a side note, Nvidia's non-operating items are larger than most operating incomes in most S&P 500 companies. This is driven by Nvidia's enormous cash pile, which generates interest income. What this chart does not reflect is potential gains from equity investments. Nvidia is invested in various AI companies or AI-related companies, so there's also upside to this driver. But again, compared to the huge data center revenue or business, this line item will not be a key driver of the Nvidia thesis. This chart then shows you the resulting profit before tax margin, which again is very similar to operating margin or in terms of the wavy structure to gross profit margin for the reasons I explained previously. This chart shows you the resulting profit before tax based on all the assumptions we discussed so far, and you can see there's enormous pre-tax profit generation. But more interestingly for investors is shareholders' net income. But just for completeness, this chart shows you the effective tax rate assumed in this model. I assume a continuous increase of the effective tax rate to closer where other S&P 500 companies typically reported, which is typically around 18 to 20%. There are various reasons why Nvidia's tax rate is significantly lower than 18 to 20%, but again, this exceeds the scope of this video. This one is not important, but this just shows you the tax expenses. Nvidia will become one of the largest corporate taxpayers in the United States. Nvidia will be paying this year, estimate, just under 20 billion in corporate taxes. To show you just how massive this is, I was just pulling up real quick this data set that shows you the P&L of the US government. Here, this is on a monthly basis. Down here, you have trailing numbers, and as of June 2025, that's the latest number. US corporate tax was for trailing 12 months just over 500 billion. So keep that number in mind. So, and for this year, I forecast, as I said, 20 billion in taxes. So Nvidia alone will be paying just under 4% of total corporate taxes this year in the United States. Now we get to where it gets interesting for the shareholders. So what's the shareholders' net income? So this year I forecast 111 billion. That's up 52% from 73 billion last year. It's going to grow next year 43%, followed by 30% growth, followed by 22% growth. But to get to the most meaningful number, it's the adjusted EPS. We need to account for the net income adjustments. I expect very modest add-backs. This actually results in a lower adjusted EPS. Just keep this in mind. This is another level of conservatism built into this forecast. This chart shows you then the resulting adjusted shareholders' net income. That's the key metric we need to calculate the adjusted EPS, which is the most relevant valuation metric because it provides the most stable multiple. As a basic rule, the best multiple is always the multiple that's the least volatile. Just to give you a quick example, in Tesla's case, this is a good example. The unadjusted EPS is was completely unusable during the time when Elon's comp package was recognized. The multiple was fluctuating enormously, was completely useless for any type of valuation analysis. That's why I always recommend for valuation work, go to an adjusted metric. I do know that a lot of investors prefer the not adjusted metric just from a pure shareholder value perspective. I agree with that, but it's not the point of valuation analysis. Valuation analysis, at least in terms of what I do, is aimed at making the most accurate share price prediction possible. And historic backtesting just showed that an adjusted metric is vastly superior to everything else, including cash flow analysis. But again, this is a topic for another video. So before we get to EPS, we also need a proper share count projection. And this is very important in Nvidia's case because Nvidia has an enormous share buyback ongoing. And I expect very soon that Nvidia's share buybacks will exceed every other company's, including Apple's. And this, despite Nvidia's enormous market cap of over 4 trillion, will actually drive a meaningful reduction in share count. And that's why for an accurate EPS forecast, you need to account for it. Now we get to where it gets really interesting for shareholders, is the EPS. So in the first quarter, Nvidia reported 81 cents. This again was driven by the H20 ban. We will see a massive increase in the current quarter. Will be reported very soon. I expect $1.04. And then in the second half of the year, we will see a massive increase, which is driven primarily by the increased ramp of the Blackwell architecture, plus the incoming additional revenue now from the resumed H20 sales. This chart then translates the quarterly EPS in a next 12 months EPS number upon a given reporting quarter. This is still not that helpful. You need to translate this forward-looking metric into a continuous metric. This is what this analysis does. It's just a smoothing between two quarters without introducing inflation or deflation of earnings. It's just a necessary step, or a technical step, if you will. This gives us the first piece we need of two pieces to create a reasonable share price projection. The second piece we need is a multiple. And for a multiple, you always want to look at where a stock traded historically. And you want to give your analysis what I call a recency bias. You don't want to look back too far, because market sentiment and sentiment around a specific stock can change quite materially. And that's why you want to limit your horizon, and I typically use the last 12 months. I view the last 12 months as a good balance between not too short-termistic, because then the multiple becomes too volatile, and also not too stale by adding the periods that may not be relevant anymore. 1 year probably sounds too rather random. However, if you do some mathematical testing, it turns out that that time period delivers actually really good results. I covered this before, and again, there's a topic that would way exceed the scope of this video. So let's discuss this important slide. So this gray line is just the share price. So right now in pre-market trading, the stock briefly, when I updated this, touched to just under $172 a share. The dark blue line is the true PE multiple of Nvidia. So the true PE multiple is if you from a given trading session's perspective take the next 4 unreported quarters of Nvidia that were actually reported. In other words, this is equivalent to a forward PE where the consensus is 100% accurate, so it's the dark blue line, but you can only do it for periods where from the last trading day you have 4 unreported real quarters from Nvidia, and of course right now we don't have that. We don't have the future quarters. So as you approach a time frame where you don't have 4 quarters anymore, you need to add a forecast quarters. So you first start with adding 1 forecast to the last 3 reported. You add 2 forecasts to the last 2 reported, and so on. And then at some point you go completely to a forecast earnings. And then obviously the implied multiple based on these forecast earnings. And this is what this chart shows you.
Order filled.
Just to understand. So and what this analysis shows you, Nvidia currently trades based on my estimates, and the current share price 172 at around median PE over the last 12 months of 32 times. But currently the implied multiple is actually lower. It's still below the median, which implies the stock is not overvalued. These green and red lines show you always the standard deviation, 1 time standard deviation, and the red lines 1.5 times standard deviation. So you can see the multiple is actually below where it was on a median basis. So if you hold the stock, you should get worried once the multiple gets significantly above the median, touches the standard deviation, and especially when it runs into the red line, because then it signals the stock by its historic trading levels is really pricey. So then we have the 2 pieces that we need, earnings projection and a multiple, and then we can put all this together, and this is what you see on this slide. It then projects the implied corridor from the earnings, from the multiple, and you can see so first of all, again, red and green imply the 1 and 1.5 times standard deviation, and the gray, the gray line, thick line, is on a medium basis based on the current earnings outlook, where the stock basically I'm simplifying, on average should be trading. And you can see, despite the recent rally, the stock is actually kind of at the lower end of this implied historic range. This corroborates the assertion that the stock is still not overheated, and analytically implies that it's not the time to trim. It's the time to trim when the stock goes out of the gray range, above the gray range, and again approaches green or red. Basically, when it touches red, it's a very high time that you should at least consider taking some profits, because based on historic trading, it would be unlikely that the stock could sustain that level for very long. This slide is the same slide as we just looked at, just on a slightly zoomed in way, and also shows my price target, $240. So a price target by default is always the next 12 months. So right now it's July, and sorry, here's a mistake. This should say July 15th, not July 17th, but it doesn't affect anything. And the bottom line is there's still a significant upside, and also keep in mind, a price target of 240, like in my case, doesn't mean, okay, this is the all-time high. This is just where, based on current sentiment, multiple earnings, yada, 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 this is where I think the stock will be in 12 months. But in 12 months, there will be a new analysis. And depending on how Nvidia and the market is trading, there will be an update. And in 12 months, my next 12 months price target might be significantly higher. So Nvidia might be a stock that you should be holding for, I don't know, 10, 15 years or more, who knows. But this is why you need to keep doing the work and always retest your hypothesis. Also check how the stock is developing, or not the stock, how the company is developing. And then here, just another version, more zoomed in. So basically, currently, if you take everything together, the stock right now, or for the remainder of this month roughly, would only get overheated once it gets meaningfully above 200, is basically the conclusion. If the stock, based on what we know today, approaches 220 in the next few months, I would have to alert my subscribers and tell them, okay, maybe take some capital out of your Nvidia allocation and wait for a slight pullback before you add again. Okay, with that, that's the end of this video. I hope this was helpful. I will publish this, as I said in the beginning of the video, probably in 2 or 3 weeks widely, so others can also benefit from this research. Thank you very much. Bye-bye.